Hi, everyone. We've had some really great discussion of climate finance, and we're going to shift gears a little bit, but you'll hear some familiar themes. I know Sir Ronnie Cohen earlier was talking about sort of, are we going to, in that conversation, Raj was asking him about, will we reach a ESG, SDG tipping point of sorts? And sort of what does it take to get there. So we're really going to dive in and talk about some of the trends we're seeing in ESG, in this environmental, social, and governance investing space. There has been tremendous growth in the last couple of years in that space, though how much of it is sort of interrogated is a question mark. There could certainly be some greenwashing and other sort of questions about how ESG is being measured by individual organizations. And joining me in sort of this conversation around what we're seeing in the evolution of the ESG space and what the potential might be there to mobilize some of that, those trillions of dollars into the SDG space will look like. And so the two people joining me for this conversation are Marcos Neto, who's the director of the Finance Sector Hub at the UN Development Program, and is leading a lot of work around this, including with a G20 working group on sustainable finance, and Tariq Fancy, who's the founder and CEO of the Rumie Initiative, which is an edtech nonprofit. But today we're sort of tapping his expertise in the finance industry. He served as BlackRock's chief investment officer for sustainable investing and led their ESG work before leaving, and has become pretty outspoken about some of the challenges of ESG investing. So thank you both so much for joining me. I'm looking forward to a great conversation. Tariq, maybe we'll start with you. Can you help sort of paint a picture of what we're seeing in the ESG space? It's tremendous growth. In July, I think Bloomberg predicted ESG assets are on track to exceed 50 trillion by 2025. In 2020, it was about $35 trillion of assets sort of purporting to be invested in ESG. What can you tell us about the trends and what might be behind those trends?
Thanks for the chance to speak here, first of all. And in terms of the ESG space, I think there is enormous growth in it, in large part because people are looking for solutions to social problems, in particular climate change. And often in the absence of government action to drive that, they'll tend to look at, whatever else is available, right? So consumers will look at what products they buy on the shelf, what funds they invest in. Institutional investors will look, and sort of say, how can I use the tools I have at my disposal, including my investment capital, retirement savings, to not only achieve a solid return, but also, ideally, sort of achieve social goals alongside that. And I think the challenge that we've seen in this space is that there's explosive growth around it in recent years, but because there's no real regulation on what it means to be ESG, what it means to be a green fund, there's been a bit of a race to the bottom where for the most part, it tends to be marketing, right? Because the reality is that you can attract greater client dollars if your fund is an ESG fund than a non-ESG fund. You can often charge higher fees for that, right? So the average ESG fund has over 40% higher fees. And if no one is actually going to regulate what that means, you end up in a situation where, for the most part, the impetus in the industry at a systemic level is to paint whatever you had green because it, fly off the shelves. Like, it's kind of like if you have two apples at the grocery store and I'm selling an apple and Marco is selling another apple and I want people to buy mine. If I can put an organic sticker on mine and no one's going to police what that actually means, I'm going to, of course I'm going to do it. Then he's eventually going to figure out and everyone's going to do it. And the challenge ultimately, I think, is that when you look at the incentives of the system, the only way you can drive the kind of change we need is that you need government to play a critical role. Not government as provider, right? I'm not saying that, imagine we need more electric vehicles. The answer is not that government goes and starts, building electric car factories. That's not realistic. But government as regulator is a very, very important role, right? It's the role where they can say, we need to regulate and put fines on pollution, right? We need to, it's sort of like a referee setting the rules of the game. At some point, if the game is being played dirty, you need the referee to come in and do their job and clean it up. And what we've seen in recent decades is that not only has that not happened, but ESG has emerged and practiced the way it is today. There's some useful data, there's some useful standards. There's a lot of great people, especially young people, who are very passionate about it, but they're being combined into narratives that try to convince us that we don't need government regulation because, businesses will do the right thing all by themselves, sort of like a good sportsmanship argument on the part of the players in the field, which I saw very clearly across the data of the largest asset manager in history is definitely not true. And secondly, you have a bunch of products and a lot of those products actually have no impact, right? Because again, no one's policing what they are. And so they just will grab shares already traded in public markets and they'll give you a slightly different basket and use it to charge more fees. That's concerning because the last thing I'll say on that really quickly is that, if there's a financing gap of $1.5 trillion, and then people say, wow, we've got 500 billion of ESG funds, so that's part of the solution. It's actually not if there's no real impact out of that, right? There's no additionality. It's just basically moving money around to charge higher fees. In the end, that 500 billion may have zero impact at all. So I do think ESG has potential, but the way it's being practiced today I'd argue, is not only not helpful, it's actually harmful because it provides a placebo where we think that we're doing something, but we're not. And every year, ESG talk goes up, ESG assets go up, and they go up alongside, emissions and inequality and all the things that they're meant in theory to actually prevent.
Well, thanks for that perspective. And I think it's an important one because you come from the space, you saw from the inside what things look like. And I think there's also a question here that maybe we'll get into a little bit later about the distinction between ESG and impact investing, which is much smaller than the ESG investing market. But Marcos, I wanted to turn to you and bring you into the conversation from where you sit at the UN, at UNDP. I know you've been working on launching products that have integrity and standards built into them that are trying to sort of appeal to this ESG space, SDG bonds, et cetera. So tell me a little bit about how you see the sort of evolution of the space where you sit, and any sort of reactions or response to what Tariq's been saying.
Thank you, Adva. Great to see you again, and thanks for the opportunity. And look, I think Tariq, it's a spot on, right? We were just listening to the comments about the $100 billion that needs to be happen out of COP26. Well, let's not forget that $100 billion is not just public finance; it's public and private finance, right? That is supposed to compose that $100 billion. At least that's what the developed countries wants to say. If that is the case, then the integrity of the private capital that combines into that $100 billion commitment from rich countries to developing countries must be 100%. And I do think that, the current description that Tariq gave it, it's very concerning. And part of the problem is, what are we trying to accomplish? And I do think that the ESG universe historically comes around of this from a kind of a passive checklist, do no harm exercise, right? Now, why does this matter for the United Nations Development Program? Because we actually have something called the Sustainable Development Goals Agenda 2030, right? Or the Paris Accord. That should be what drives that private capital investment. It is, your issue about impact, right? And it's not so much about impact investment, which is smaller. It's about the whole financial system, right? Aiming towards something, having a purpose. That purpose, I would argue, right, is the Sustainable Development Goals, is the Paris Accord. And if you want private capital to deliver on the SDGs, right, then the rules of the game have to change, right? They have to change it from the point of view of the incentives for private capital, the role of regulation from governments. Regulation should not be just seen as, negative. There could be incentives in regulations for money to genuinely chase that impact, right? But when money is not chasing that impact, but is claiming to be chasing impact, there has to be regulation that, kind of disincentivize that washing or that marketing side of things, right? In the end of the day, what you want is all investments to have an impact. As a matter of fact, I would argue all investments have today an impact. The problem is a lot of those investments have a negative impact, and there's a lot of people pretending that the impact is positive, but not generating a lot of impact. Maybe there is a do no harm that is growing, which is already better than harm. But if we really want to achieve something, right, and that for me, obviously being the United Nations is the SDGs, you've got to tighten the rules of the game, and we are very happy as UNDP to be working with the G20 to put in place, it was just endorsed by the heads of G20, a G20 sustainable finance roadmap for the last 5 years, which is starting to put it in place. If you want an architecture of policies that need to be put in place in G20 and beyond to tighten the rules of the game. Because I agree with Tariq, we need regulation. We need the governments to come in place and determine where does this capital go, both in terms of impact and also in terms of geography. Because if only 50 countries or 60 countries in the world are in the highway of financing, right? And most of the developing world and in Africa and others are not receiving any investment, any capital. That's also a problem, right? I'm delighted to see the European Green Deal driving regulation in Europe, driving capital towards green and the SDGs with a growing degree of integrity in Europe. But if it just stays in Europe and it doesn't go to Africa, we've got a problem still, right?
So Tariq, I guess a question for you there. In terms of driving investment to lower income countries, to sort of creating opportunities for investment to go into lower income African countries and not just stay in the US, in Europe, in more highly developed markets. What do you think the prospects are for that? And what needs to happen to, are there incentives that need to come into place? And we'll come back to this conversation about regulation in just a second, because I want to hear some specific sort of recommendations from both of you on that. But on this issue of sort of driving geographical diversity of some of the world's major investors, and how do you think that can happen? Because that does seem a critical component of achieving these SDGs.
Yeah, it does. I mean, I would always say, look, one thing I'd clarify up front is that, there's government has a critical role to play, but again, it's the financial markets that are going to have to do most of the heavy lifting, right? Most of the jobs and capital are in the private sector, so there's no question that they're not exempt from it. The question is really, how do you get them to play a critical role? And as Marcos mentioned, it's really about changing the incentives of the system. If you're within a rich country, it's as simple as saying, if you want more green innovation, then you need to have a price on carbon, and you need to sort of have adjust the incentives in such a way that you get far greater movement of capital to greater causes, right? And in a sense, that's what the role government's supposed to play, right? I mean, business and markets serve society, not the other way around, right? I mean, and I'm sort of a former investment banker with an MBA and a capitalist, but it sounds like a simple thing. And I think since the 80s, we've been beholden to a bunch of narratives that underlie the economic system that seem to convince people that free markets solve all problems. And so that you have to work within the existing paradigm, and regulation is not a question. And I think to answer your question on how capital gets to more emerging countries, I think on one level you need a significant investments in new technologies. I think those are going to have to happen in rich countries first, which have the capacity to invest in base research, pre-commercialization. They have the incentives to, again, find pollution and other things, so that you see a capital moving in a direction that is, then is not guided by anything around ethics or good sportsmanship. It's just the return is now in another place. And by adjusting the incentives, you see a quick movement there. I think forgetting it to emerging markets, I think, you need a whole bunch of tools around foreign direct investment. And I think that the receiving countries also need to then be in concert with rich countries in the sense of the incentives that they're putting in place, right? So that, again, foreign direct investment, it has to be the kind of investment that has additionality, right? I'm sure we'll get into ESG versus impact in a second, but it has to have some additionality. And I think that at the local level, again, the capital is going to chase the returns. Like, the one challenge I think around the space is this idea that, like, ESG somehow does something, pulls you away from the single financial bottom line that is underlies the markets and all of the incentives of the system, and always has and always will, right? I started my career as a vulture investor, like distressed debt, very, very sharp elbowed. Now I run a ed tech nonprofit, quite at the extremes, right? But having seen the sharpest side of finance, I can tell you right now, we would finance anything that's legal and makes money. That's not a bad thing. People aren't evil. It's just the way the market system is supposed to work, right? It's efficient precisely because within the guardrails set by the government, you have people chasing the best return. And I think that's why it's so important to get capital to emerging markets. It needs to start with rich countries setting the right kinds of incentives in their own countries. I think it's a lot easier than for developing countries to at least try to do the same, recognizing that the economics are difficult in those places. There is a role for first loss capital and subsidized approaches, right? I've worked on things like that to bring renewable power into emerging markets. The challenge, I think, is that there's a limit to how far you can get on that, right?
Yeah.
I mean, and that's going to reaching into the government kitty. And I think there's limited money for that. And I think it often might be better spent on sort of base research and other things that unlock, commercializable technologies that we need.
Yeah, so let's talk about this issue of regulation. We've seen, Marcos, you alluded to this, some efforts in Europe to create some regulation around what's, considered sort of more, green investments. We have seen some sort of movements out of the SEC in the Biden administration. I think it'll be interesting to see if there's any more action there. But, some proposed rule changes to ERISA, for example, which could, make non-purely financial factors, more a part of discussion for those institutional investors. So I'm curious from both of you, what are some specific regulatory actions you think countries can take? And is there an appetite there? I mean, in many cases, it's the very institutions who would be regulated who are quite powerful in Congress in the US, for example, who might be pushing against additional regulation. So how do you sort of strike the right balance and in, politically charged environments really push forward on this regulatory front?
If I can jump in here, I think we have seen interesting progress, right? So that's not all completely, bad. If you look at the creation of a new sustainability standards board for disclosure, right? And I think tidying disclosure is becoming a bit of a mantra now. And the IFRS creation of an international sustainability standard board is welcome, right? But it's not enough. Why? Because that standard board is going to focus on enterprise value. So it's going to focus on disclosures that matters to investors, not necessarily the full impact that a company has on society, positive and negative. And you do need that holistic point of view. You do need to see how a company and all the externalities that a company presents, positive and negative, are fully accounted for, right? So welcome the IFRS, welcome the Sustainability Standard Board. It is a track that we've seen it before with the Accounting Standards Board. It worked in create transparency. So it's most welcome in that aspect. Right, but I do think that is not enough, and that the search for that impact is still something that regulation is going to have to show. And you see that in Europe. Europe was regulatory framework with EFRAC around issues of double materiality being important. It's perhaps the way to go on that aspect. I also think that disclosure in itself is not enough. Right? Let's be honest. Okay. The United Nations created many years ago the principle for responsible investment. And those principles are fantastic. There's nothing wrong with it. There are basically 2,500 assets that have subscribed $100 trillion to the PRI. Okay. And as you mentioned, Adva, there's $50 trillion on the ESG now. Well, you know what? If in the real economy, all this money were actually behaving like the principles that they behaved, we wouldn't have this conversation, right? The gap to finance the SDGs wouldn't be going up, right? It would be shrinking, So you've got a problem that a lot of what you have in the system right now is too loose, as Tariq has referred to. And it's it's a market failure that is being attempted to be solved by the market-based mechanisms itself. And you can't solve a market failure just by market-based mechanism. You need the governments to come in that aspect. And I think the last point that I would say is that you need decision-making information, right? You need information, and you need standards that are more than the disclosure, that they allow for the decisions to be framed in a way that you are searching for that financial, which I agree, it's always going to be there, the financial return, but also fully capitalizing or fully including, right, the externalities inside that financial return. So I think that is what needs to happen in terms of decision. We as UNDP have created a series of standards for decision making. For private equity, for bonds, for enterprises, and together with the OECD for DFIs. And we are seeing the sovereign bond market using our standards, in Indonesia and in Mexico and Uzbekistan. We are pleased at the beginning of using of those standards to generate a little bit more integrity on SDG investment in that aspect.
Right. Tariq, I don't know if you want to jump in on that, but one quick comment on my part. I think one of the things that you really highlight in that, Marcos, is that one of the things we are seeing is a divide between the rhetoric and the action.
Right.
And I think, I think about that a lot as we're looking at COP, as we're looking at corporate commitments on net zero, for example, which, we've seen a ton of, across corporates and across the financial industry, pledges to get to net zero. But then often no concrete plan with which to get there. So I do think that and that's a place where, yes, governments, but also perhaps civil society organizations like the UN and certainly journalists have a place to sort of create some accountability around connecting the rhetoric and the action. I think the challenge in the ESG space is that it's very opaque. There's not a lot of public reporting out there. There's not a lot of standardization of the ratings, though I know that IOSCO, the International Organization of Securities Commissions, did recommend earlier this year regulating the ESG ratings sector. So I'm also curious if you think that will be done or could have an impact. But Tariq, I'll go to you with that question and just if there is sort of additional regulation of this ESG sector, do you think that will increase the cost of delivery of sort of ESG products? And will that make an impact for, people who are low income?
My concern is that ESG done poorly is a placebo, right? Because the reality, as Marco said, transparency alone isn't enough. Right, there's been transparency around CEO pay levels for decades. It just increased. It's not like having transparency meant that it sort of rationalized a bit. You have, transparency in calorie counts in New York, right? I'm not sure that that's done that much around obesity. The reality is that if you have a market failure, transparency alone isn't enough, right? It's like if you use the sports analogy I was using, transparency allows you to see that certain players are kind of playing dirtier than others. But unless the referee is there to penalize them, then no one internalizes that externality, right? And so that's the question. It's basic externalities in economics, right? That Arthur Pigou or whatever came up with, 100 years ago. And these are externalities that you would argue that it's the government's role to protect the long-term public interest. If they're not doing that, you have a system where the incentives are extraordinarily short-term today, right? So the average CEO tenure is 5 years, shortest been decades. Average CEO pay is 320 times the average industry worker. That's the highest it's been in decades. If you have a system where people get paid within a few years what it used to cost, take a decade plus to do, it's not even about the individuals. I'm not casting aspersion on specific people. I'm just saying at a systemic level, you're going to find, much as we found when incentives were misaligned around the financial crisis, that they are going to take a lot of risks in the near term because they get paid a lot and kick the can down the road on long-term things, right? Because if you're not going to feel the impacts of climate change until 10 or 20 years, and you get paid in the next few years, frankly, the incentive is to market yourself as being sustainable rather than to actually make these long-term investments that pay off. And fundamentally, the question that we have to ask is ESG the answer, or is, we have to reform the entire financial system? here, like a provocative question. I wrote a paper a few months ago that seems to have gone viral called "The Secret Diary of a Sustainable Investor," which anyone can find online. It's on Medium. And one of the points I make in it is that, in the post-World War II period, let's take the U.S. as an example. There were better outcomes from capitalism in terms of, certainly economic inequality, right? There was a vibrant middle class. There was better environmental protection, and Richard Nixon founded the EPA in 1970, right? All of this happened without the acronym ESG, without the idea of having a parallel financial system of green assets with premium prices that are meant to undo what the regular financial system is doing. My concern is that the reality is that we need the entire financial system to be green. That's never going to happen with leaving it to the market to self-correct a market failure. And every year we find, like, it's 2021 now. I mean, someone won a Nobel Prize 3 years ago for arguing we need a price on carbon. He'd been saying it for decades. And the more we talk about ESG and done poorly, where it's just generally marketing, the more we actually mislead the public. This is one of the points of my paper and study we've done. They actually feel like you need less government action, right? So it's kind of like players on a field, they're playing dirty, and then they're arguing, good sportsmanship is the answer. And the more that they spend billions marketing and then, frankly, lobbying the referees not to do their job, the slower it is that we actually get referees and the kind of change we need. And I think fundamentally the question is really, what is capitalism itself is at risk if that's the best answer we have? Because, listen, I turned 43 recently, and the data shows that the majority of the people younger than me don't believe in capitalism, right? So at some point, unless we can address the climate crisis, we won't only see, challenges from all of the things we know around climate change and everything else. We're also going to see, the entire systems that the Western democracies in particular find themselves in the crosshairs of a significant pushback, because otherwise there's no way to look at climate change in the way that governments have responded today and look at it anything but short-term incentives playing out and kicking the can down the road in a way that's kind of intergenerational robbery, right? I mean, that's why Greta Thunberg, she's 18. I've never seen mostly 18-year-olds. You hope they're quite optimistic. She's quite cynical. It's not her fault. It's her generation is seeing a complete failure to address a crisis that they know they're going to end up bearing the consequences of more than anyone else.
Yeah. So we've got about 2 minutes left, and I'm going to go to Marcos first, and then maybe we'll come back to you, Tariq, for 30 seconds at the end. But as we look at the path forward, what needs to happen? What can happen? What will sort of force the system to change? How do you push governments to play the regulatory role that they need to play? So what does the path look forward in sort of ESG regulation and in ensuring that the financial system can, adapt and support these challenges of inequality, of poverty, of climate, et cetera? So Marcus, I'll go to you first.
Well, I think if you look at climate, it has become clear for the financial system, the climate poses a risk, right? A risk for pension funds, a risk to the integrity of the financial system. So actually, this is why climate has been taken on a lot more than other parts. So I think as other issues become equal to climate in terms of financial risk, more integrity will be demanded. But the question is, you have an opportunity. The SDGs presents itself a $12 trillion a year opportunity for capitalism, right? So the question is, move away from defense and risk management to change the financial system to maximize the opportunity that is there, which it is a financial opportunity, a social and environmental. I agree with Tariq, and I think that's in the end is the dream, right? A financial system that doesn't need to be called green or impact because it delivers the purpose for society. And that purpose today in the world is represented by the Sustainable Development Goals. So let's deliver that, and end with all the acronyms and generate that in that sense.
Tariq, any last thoughts?
I agree with what Marco said. I think my goal this year was really been to spark a debate. How do we get there? I think we need to have a debate about the role of government. I think that's an overdue debate that seems to have been pushed off since the 1980s. And unless we actually have that debate in serious fashion, especially amongst the business community and especially in the US, I think it's going to be hard to get anything done because governments are going to there's too much money sloshing around the system. And so you really need to get business leaders to ask, what is responsible business? And if it requires the referees coming in and doing their jobs, then that's what it requires.
Great. Well, thank you so much. I look forward to sort of continuing to have this conversation with both of you and with other folks. I think it's, really interesting to see how all this is evolving and the role that it could play in development finance. So thank you both.
Thanks.